I almost dumped my entire financial portfolio last week until one hidden metric stopped me. You are misjudging this massive wealth transfer, and it will cost you. The quiet monopoly controlling the algorithms will change your strategy completely. The smartest voices on Wall Street are screaming that artificial intelligence is a death sentence for financial researchers. It makes sense on the surface. Right now, current flagship models can parse a 100-page earnings report and extract sentiment in about 4 seconds. That raw processing power has led nearly 40% of retail investors to assume legacy data giants are finished. If an algorithm can do the work for pennies, the massive subscriptions charged by institutions seem doomed. I spent days mapping out this exact collapse scenario. But every time I looked at the actual enterprise spend flowing into these legacy behemoths, the numbers aggressively contradicted the narrative. The cash was not drying up. It was accelerating. And the reason why fundamentally breaks how most people understand machine learning. Stop thinking about algorithms as magic oracles and start looking at them as industrial engines. Engines need premium fuel to run, and in finance, that fuel is verified historical data. An artificial intelligence cannot hallucinate 30 years of bond yields without triggering catastrophic legal liabilities. This is the first major clue. The models themselves are becoming commoditized. Everyone has access to world-class neural networks now. The true bottleneck is the proprietary information required to train them effectively. When a major asset manager deploys a predictive model, they cannot afford even a tiny hallucination rate on a billion-dollar trade. They need absolute certainty. But knowing they need certainty still leaves a massive piece of the puzzle missing. Look directly at who actually owns the rights to that certainty. S&P Global controls the fundamental benchmarks of the American economy. They literally own the baseline index data. Every leading AI lab building specialized financial tools is quietly doing the exact same thing. They are signing massive licensing deals with companies like S&P Global to legally ingest that proprietary data. The tech giants are not replacing the data gatekeepers. They are becoming their biggest new customers. It takes decades of regulatory approval to issue accredited credit ratings. A machine learning startup cannot just code its way around federal financial regulations. S&P Global has an impenetrable regulatory moat protecting its core revenue. Which brings us to the actual reality of the threat. The reveal is that artificial intelligence is not a threat to S&P Global at all. It is the biggest margin expander in the company's history. While retail traders bet against them, S&P Global is double-dipping. On one side, they sell their exclusive data libraries to tech companies at a massive premium. On the other side, they deploy those same advanced models internally to slash their own operational costs. They are using generative systems to automate their own lower-level analyst work, dramatically increasing their profit margins without lowering their subscription prices. They have weaponized the exact technology everyone assumed would destroy them. But understanding this dynamic only matters if you know how to leverage it in your own strategy. Remember what I said at the beginning about misjudging the wealth transfer. This is exactly how you correct that mistake. The market is currently obsessed with hardware companies and model builders. But the intelligent capital is quietly accumulating shares in proprietary data monopolies. Your portfolio strategy needs to shift from asking who is building the smartest artificial intelligence to asking who owns the data the artificial intelligence desperately needs to consume. S&P Global is just one prime example of a much larger structural advantage. Any business sitting on decades of highly regulated, hard to replicate, exclusive data is fundamentally immune to AI disruption. In fact, their assets just became infinitely more valuable. Yet there is a severe blind spot in this thesis that could wreck everything if ignored. This is the part where it either clicks or it doesn't. The only existential risk to these data monopolies is the perfection of synthetic data. If the smartest labs figure out how to generate perfectly accurate financial environments without relying on historical inputs, the licensing revenue evaporates. Right now, synthetic financial data is too risky for regulatory compliance. The federal government mandates real-world audit trails, keeping S&P Global entirely safe for the foreseeable future. But as neural architecture evolves through the late 2020s, that regulatory barrier will face intense lobbying from Silicon Valley. The investors who win this decade will be the ones actively tracking the legislative battle between synthetic generation and legacy compliance. The lines are already being drawn. Subscribe and hit the bell to track the real signals before the mainstream.